Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny, and today we're going to talk about Dr. Michael Burry and another tweet that he put out about money velocity and how that may be indicating that inflation is probably going to be a little bit more of a persistent problem than everyone wants it to be. And we're going to talk about it.
Ooh, all right. Let's get to it, guys.
Two stupid guys trade stocks.
All right.
All right.
Danger. Ooh.
Danger, Will Robinson, right? I mean, that's the whole premise here, is that this may be a bad sign. So this is the tweet here, okay? He talked a little bit about money velocity. Do you know what money velocity is, Dylan?
Yes, it's when you pick quarters off the street and you see how far you can throw it.
Yes, 100% correct. That's what Jerome Powell said. Actually,
You're
it's the
welcome.
rate of kind of transactions that each dollar goes through. So it represents how fast a dollar is moving through the economy. Right? The
Mm,
analogy here, where this becomes like an issue, is imagine putting your thumb over like the end of a hose, right? In order for the conservation of flow to maintain there, the velocity of that water must increase. That's how you can squirt people in the face, you know?
you okay? So heavy
Yeah.
flow. Okay.
So
We
that's what
want that.
happens is we're trying to restrict the amount of dollars in the U.S. economy right now to kind of cool inflation, but inflate the actual velocity of the money is going up, which he's saying may actually contribute to a kind of a continuation of this inflationary cycle. All right. And he's
I
citing the
may need you.
1978-79 window as evidence.
I may need you to describe this to me like I'm five.
Yeah, I mean that's exactly what I'm trying to do with the fire hose analogy. Okay. Um, but the main kind of point here is like this last sentence to me is redux would shock. If this truly were to happen again, it would be shocking to the kind of stock market and economy as a whole because no one's really expecting this. But we have seen some indicators that this may be occurring. However, when I look back at this 1978 time period, it's not as clear as he kind of hints at here. Um, so what you're looking at here, this is M2 money supplies from the Federal Reserve. Obviously, we had this massive spike up during COVID, and you've
Yeah.
started to see it kind of flatten, maybe even curve down a little bit towards the end here, where they're starting to take a little bit of money out of the economy.
Crazy,
Um,
crazy amount.
but when we go back and look at what M2 money supply was doing in that 1978-79 window that he's talking about, where he said it was, M2 money supply was decreasing, it looks like on this graph this is from the St. Louis Fed that it was actually increasing during that time period. So I'm not really sure where he got that particular bit of information from. However, when we look at the velocity money, those do kind of match up with what he was saying.
Okay. So this does not
Yeah.
seem good.
Yeah, so you see this little kind of hockey stick right here at the end where it's starting to curve back up. That's what he's talking about, that money velocity, how
Right.
it's starting to increase and change hands again here,
Right.
which is the indicator that he's saying is, more transactions through the economy, more opportunities for inflation. Each dollar, by moving, through more hands, has opportunity for inflation to act upon it. Therefore, kind of continuing this spiral. If you look at back in that 1978-79 window he's talking about here, we did see a significant increase in money velocity during that time period. All right. Yeah. Interesting, huh?
But yeah, so okay, question. Um,
Shoot.
if the velocity of money, which is what we want to go back to normal levels, also as it increases, will increase inflation as we're trying to decrease inflation. Problem.
Yes. That's exactly what he's trying to say, is that this is a bad indicator that inflation may be more persistent than people
Yeah,
are giving it credit for. That's what he's trying to hint at with this,
because I'm
I
getting
believe.
from this out of someone who barely understands this. You have a much better handling on this than I do. I feel like we're gonna be chilling fairly high for like a couple of years.
Well, I wouldn't say fairly high for a couple of years, but I think the point is that this isn't going to be something that's quickly vanquished overnight as far as inflation goes, and that this adds more to that narrative that we're not going to see a fast Fed pivot, which is what the market's been catching up with for the last few weeks, right? We finally come to that realization we're not going to see a fast pivot, and he's giving more evidence as to why we will not see a fast pivot, in his opinion.
Okay, that's not great.
He threw out a couple other, kind of tweets about monetary policy and that sort of stuff, as well, that I figured I'd throw into this video. But he's talking about, everyone predicting this deflation. Kathy Woods, you're a moron. But the yield curves here don't support that, and this looks like he's saying finally it looks like the Fed is having the first $90 billion, kind of QT month, and that's why these rates have responded so aggressively. What do you think
Okay.
about that?
Yeah. this is why my trade worked out so good, why I left, because it dropped so fast. Okay.
Yeah. It was very aggressive in terms of its movement. If for something like bonds to be moving that fast, that's pretty surprising.
There's
And
a lot.
this is only the first month of the $90 billion. Like, man, there's a lot more to come.
There's
Still
a
have several
lot more.
trillion. It's like $4 trillion left.
Goodness.
And this one is actually super fresh, hot off the presses, and it's still showing you that there's silliness in the market. Talking about how many companies came to the market with $1 billion market cap and negative EBITDA. I mean, crap. You and I are more profitable than this as a goddamn stupid little YouTube channel.
Okay,
We're not
this
worth
is
$1 billion.
bad. I didn't know this. 208 still?
Yeah.
Oh.
Yep. Yeah. There's
Okay.
still a lot of excess, a lot of cash floating around the market that probably doesn't deserve to be there,
Man.
which is pretty scary.
I wonder what this number was like September 2020 when everything was going crazy.
I mean, that's true. You can go back and look at that for sure. There's definitely a correlation of new issuance, IPOs, and kind of economic cycle standpoint and where you are in the cycle. And finally, he did throw out this one last little one talking about how, like, basically patting himself on the back, saying, like, I've been right more than you guys want to give me credit for. How he came back and was talking about the whole COVID pandemic, and to a degree, his predictions have definitely held up pretty well, I would say. And then he talked about the all things bubble, which we're starting to see unwind now. And, the real question is, how deep does this recession really go?
So I will say he gets a lot of shit because he seems like he's always coming out short. If he's not like right within 2 weeks, everyone's like, you're wrong. You don't know anything.
Yeah.
Like, dude,
Yeah.
no one calls something within like 2 weeks. That's crazy. If you say like we're gonna lose a lot of value, the average PE of this buy is gonna go down, give it a year and a half. Like, it's not immediate.
Yeah. He actually tweeted even out to defend that. I didn't put it in this presentation, but he talked about how his time horizon is longer than Twitter's.
No.
Okay. Not exactly what Twitter's time horizon is, but,
Well, we'll see in October. So,
Yeah, we shall see.
all right, guys. If this video helped you out, give us a like and subscribe. If you're going short with us and Burry, let us know. Have a good one.
Catch you on the next one.